Hi, I will talk about climate risk stress testing that was conducted in 2022 in European Union, and it was based on this paper actually published by ACB. So this is the methodology paper, and we will go over the different aspects of the methodology used by ACB. Right. So as you may know that ECB is conducting climate risk every year for the banks in the European Union. Um, but this time they also, I mean, last time in 2022, they also conducted climate risk testing. It was very specific to climate risk, and it was separately done than the general stress testing, which is conducted annually. Okay, and there are some guidelines provided beforehand. The methodology of doing that was provided to the banks in advance, because climate risk stress testing was done for the very first time actually in the European Union. In fact, it's perhaps ECB is one of the few central banks that are conducting climate risk stress testing. Not many other central banks are doing that, right? So there are different aspects of it. As you may know that climate risk has got two main drivers. One is the physical risk, the risk of having physical climate events such as drought or flood, fire incidents. And then you have transition risk, which is more about policy changes, right? The impact on the economy because of policy changes leaning towards greener economy, right? That might have an impact on profitability of companies, or decrease in the GDP for many countries, especially the developing countries where the economy is relying too much on carbon economy, right? So that's, and it was the exercise was to be conducted in March to July period in 2022. In fact, the results are already out. In fact, I will discuss the results in another video. But this is how it was done. It was first time, so things were not very strict from ECB side. There were a lot of leniency, and it was more of an exploratory analysis, such as, because ECB also wanted to know the status quo with the bank as to what banks are currently doing for climate risk, and so it was less stringent compared to the more general stress test. Okay, let's go over how it was carried out. Okay, there were multiple modules actually shared with the banks. Questionnaires, questionnaire with questions about the different, what the banks are doing currently on climate risk was part of the stress test. ECB really wanted to know what banks are doing, whether they have a climate risk framework or not. Many banks, in fact, do not have a climate risk framework in the European Union. In fact, all over the world, there are not many banks that have got a very good climate risk framework yet. It's still evolving. People are still exploring a lot of things. The final form is not there, and that's something that ECB wanted to know. So the many other questions also, right? So it's about the qualitative information on the institution's current practices. Okay, so ECB did not want any quantitative information on this. It wanted only the qualitative information. Okay, there are other quantitative questions also asked. For example, expected loss under different scenarios, right? We will come to that later in this video. Okay. Yeah, so basically ECB wanted to answer some 10 to 11 questions related to that. These are more based on qualitative information. First one was general climate risk tested, as in general questions regarding the existence and use of climate risk stress testing within the institution, whether it's a yes or no, and if yes or no, some substantiation for that. And then you have climate risk stress test governance and risk appetite, whether it's part of the risk appetite within the bank or not, what sort of governance is currently in place. Then you have integration of climate risk stress test in institutional long-term business and model strategy, whether it's in granting loan, or whether it's capital planning, etc., etc. And then you have stress test methodology. What kind of stress test methodology are currently being used? Most banks are not using that, by the way. And then you have what sort of data is available. ICAP point of view, as in for internal capital assessment, whether climate risk stress testing is taken into account or not. And then what are the future plans for climate risk stress testing or other areas of risk management. And then whether audit function is involved in climate risk stress test or not, right? And what is audit role, third line of defense role in this. And then you have application of parent company climate risk stress test former, and this is primarily EU specific, based on whether it's a parent company or a subsidiary. And you have bottom of stress test. That means at a very account level stress test, ECB is expecting banks to do. At a aggregate level, it is difficult to do at this point in time. So because it's still very nascent stage, so ECB expects that banks do this at a bottom level, but in bottom up approach. There are some metrics used actually in this. Okay, a number of them. One was yeah, the industries, right? The counterparties to which banks have lent loan, they were divided into 22 industries based on the NSE code, and based on the exposure to carbon economy, right? They were divided, and the banks were told that, okay, please tell us how much revenue you make out of this 22 different sectors. What is your exposure? What is the breakdown of it, right? This is just for the information of the regulator, that what is the level of exposure towards the carbon economy, and if in case there is a huge policy change, how will that impact the profitability. Now remember that physical risk and transition risk, they have there is a trade-off there, right? If transition risk is delayed because of delays in the policy changes, it is good in a way, but it also bad in a way, because then the physical risk will be more, right? Because of not having policies having to control the carbon emission and the pollution, etc. Right. So this is what exactly regulators wanted. What is the interest, fee and commission income from the greenhouse intensive industries? Okay, with this 22 industry, what exactly is your breakdown with respect to interest or commission, all of these things, right? So this was an important data that ECB collected from the banks. Banks were not very prepared in most cases, I would say, so because lack of data availability, but ECB informed the banks that there will not be any finding as such, especially for the first time. I think going forward there may be some findings, so there were a bit of a leeway in that regard. Yeah, so then also impact on direct and indirect emissions. How is that going to impact the profitability? And then there was this index calculated, right, for each client. The counterpart is GSG intensity. Okay, so that's some sort of index. It's more of a scorecard but it's more of a deterministic, as in it's not a statistical scorecard. It's more of a formula used to assess counterparties' exposure to greenhouse gas intensity. Okay, so some formula used there, right? Very simple formula actually. I think this is not very foolproof. Over time they will use more even sophisticated formula, but I think for now it's fine. It's just a division of few numbers. And then you have the bottom of stress projection at an account level. Okay, and what it says that banks must provide the bottom of stress test exercise targeting transition risk and the physical risk. So with respect to these two type of risk, banks should provide some sort of a projection in the future how their profitability will get impacted. Transition risk is, as I've said, is more policy related, whereas physical risk is actual physical event. Climate risk, physical events such as pollution, water stress, deforestation, fire, and so on and so forth. Now, in transition stress test covers potential financial losses both in short term as well as in long term because of different risk scenarios stemming out of policy changes, right? So one is okay, all of a sudden there is just policy change. The other is okay, in medium term is happening, and the third is like there is a there is a delayed policy change. Something called disorderly transition. That means it is not happening properly. There is a delay there, right? So if there is a delay, it's in a way it's good for the banks. However, indirectly it may be bad through physical risk, because physical risk will increase in that case, right? And banks were also asked to assess the long-term strategy with respect to these three scenarios, right? Short-term, medium-term, as well as the longer term, right? And the assessment is primarily on the disorderly transition. That means if there is a delay, what exactly is the impact, right? So there is a positive impact, no doubt, but from a physical risk point of view, there may be a negative impact. All right, and the scenario was based on the disorderly transition scenario developed by the Network for Greening the Financial System (NGFC). Okay, I think it's a global one. It's not just related to ECB. Based on these scenarios, I think they have asked banks to provide do an impact assessment. Right. And then with respect to different portfolios, whether it's mortgages and corporate, so retail or non-retail, you have some rules to follow, and the stress test was separately done for retail and non-retail. Here is the list of exposure class where the stress test was conducted for mortgage, both for retail as well as for commercial real estate. For corporate side, specialized lending, you have real estate secured by real estate, deals secured by real estate property, not secured by not secured by real estate property. Okay, there is a separation. Yeah, and then you have corporate SME and corporate non-SME. Yeah. So there are different specific rules for separate for these portfolios. So there is a variation in that, and the banks had to follow this. So banks were asked to split the exposure, corporate exposure, which are either not secured by real estate property or secured by real estate. Real estate plays a big role in climate risk because if there is a flood, or there is some sort of a policy change related to climate risk, I think real estate is quite heavily impacted. The value decreases, the collateral value decreases quite significantly, and because of that, it's good to make a distinction. Especially any physical asset which is used as a collateral, it will have the same impact. Yeah. Also, there are some requirements from a market risk point of view, but I'm not going to go through the market risk part for now. Yep. Yeah. They're also expected to provide the expected credit loss projections. Okay, from IFRS 9 point of view, in IFRS 9 you have already the different scenarios. But from IFRS 9 point of view also, banks were asked to give expected losses. There are two scenarios provided, baseline and adverse, and these scenarios were defined properly. There was an Excel sheet even provided by the ECB. Banks were asked to provide projection for both the disorderly transition scenario and the baseline scenario. Baseline scenario means everything is fine, the transition is happening normally, and the special scenario is that if there is a disorderly, that means there is a delay in the implementation of these new policies. The Paris Agreement, all these things that countries are supposed to follow in short term, in medium term, and longer term. Okay. Yeah, so that was a short-term assessment, but from longer-term perspective also, banks were asked, okay, what exactly you expect the impact would be in long-term. Long-term assessment is more difficult. Database projections are very difficult actually, so it will be more than qualitative, right? More based on banks' gut feeling as to how much impact they expect to have because of these changes. Okay. Both for 10 years and for 30 years. Okay, for 30, 40, and 50. Yeah, and then you have similar sort of stresses for physical risk. Okay, and for physical risk, they have taken two climate risk event, since it was particularly for Europe, and in Europe, two climate risk events are very important. One is the large flood, and then you have drought and heat wave. Flood is a very common thing in the Europe, and so that's the reason why regulators are given special emphasis on that. Um, so the assessment was primarily on the direct impact of physical risk, and not on the impact on the insurance companies, the indirect impact on the economy. So that is not something taken into account. Okay, and then even for drought and heat risk scenarios was given, like, okay, if there is a drought, what will happen, right? And provide us the expected projections for expected losses and all, right? So that was exactly it was done. For the physical risk, it was primarily done for the corporate part, okay, not for the retail. These were the portfolios for which only the corporate portfolios were used for this. And the methodology was, in drought or heat scenario, the entire EU is hit by wet in 2020, which hampers economic activity and results in output losses for vulnerable industries. Okay, and that's the current scenario, right? In short term, what exactly the impact you see? Right, so that's exactly what was expected. Similarly, how it was expected for the transition risk, projection for expected credit losses for different scenarios, even for physical risk was expected. Yeah, so these are the scenarios, and based on these scenarios, banks had to provide the projections. Okay. And you have the baseline scenario, that means without any drought or heat wave, and you have stressed projection, that means there is a heat wave. So there are just two scenarios. Okay. Similarly, for flood risk, the same exercise was conducted. Okay. Again, okay, the flood risk was for both corporate as well as for mortgage. Okay. Residential mortgage, I think only. Yeah. And they were also given flood risk map actually, and scenarios were generated based on that. No risk, low risk, and medium risk, and high risk areas. Okay, and they were asked, so in residential real estate, for example, right, you can group your clients based on where uh, the houses are located. Okay, some houses are prone to getting affected by the floods more than the others because of the locality, right? And that can be derived based on the locations, right? So since you have this particular map in Europe, right, and this is just one country has been used. Okay, sorry, it's the entire European Union, sorry. So you have the green, which is okay, no risk, and then you have, okay, so green is minor risk, blue is low risk, amber is medium risk, red is high risk, right? And then you assign some sort of a weight and do the projection for expected grade loss, right? For each of these indicator, you have some sort of a weight provided by the regulator. You can use that. also for credit loss projections, right? And there are some other risks also involved, but not much has been provided about that. For example, reputational risk and operational risk and so on because of these incidents. But I think stress test does not include all these extra risks, but it's primarily on the credit risk side, on some aspects of market risk as well. I will discuss more about it in another video about the results of this stress test. Okay, thanks.